So if you're tracking the energy markets this week, specifically looking at these final days of July 2026, you're seeing this just massive flashing contradiction.
Yeah, contradiction is definitely the right word for it.
Right, because on one hand, you have the United States government quietly making these historic multi-billion-dollar moves to physically build domestic nuclear infrastructure.
Mm-hmm.
But then on the other hand, the biggest, most liquid uranium equities in the world are just aggressively selling off. I mean, the stock ticker's flashing red, while the actual physical supply chain is building this absolute fortress.
It's a textbook structural divergence. Like, the screen is reflecting this short-term positioning game, while the geopolitical reality on the ground is moving at a pace we just, haven't seen in decades.
Which makes this week's data an absolute masterclass in reading between the lines. So the mission for this deep dive is to unpack the underlying plumbing of the uranium market to see why those surface-level numbers are deceiving you.
Exactly, because we're looking at a spot market that is totally frozen, a long-term contract market that is soaring to cycle highs, and an impending earnings report that really has institutional Wall Street holding its breath.
Yeah, so we have to start with that pricing disconnect.
Yeah.
Because everything else, the government moves, the corporate acquisitions, it all stems from how uranium is currently being priced.
Right. And the pricing structure is really the engine of the entire thesis right now.
Yeah.
If you look at the spot price, it's stuck in this 8-week consolidation band.
Right around what, $86?
Yeah, sitting right at $86.05 per pound. And it has been incredibly stubborn. I mean, we even saw a U.S.-Iran ceasefire pause hold this week, which ordinarily might send some real ripples through global energy markets.
Sure, you'd expect some volatility.
Exactly. But the uranium spot price didn't even blink. It just completely shrugged it off.
But the spot price is really just what you'd pay if you wanted a pound of uranium delivered tomorrow.
Right.
It's kind of like a real estate market where current home values are totally flat. Like nobody is paying a single dollar more to move in today. But buyers are willingly engaging in this massive bidding war to lock in a contract for the exact same house 3 years from now.
That's a really good way to frame it.
Because the long-term contract market, the term price, is sitting up between $94 and $95 per pound.
Yeah, which is an $8 to $9 premium over the spot market. And that spread is actually widening, not compressing.
Which is crazy. I mean, I don't know many markets where you willingly pay a massive premium to delay your delivery. So why are buyers doing that?
Well, to understand that, you have to look at the actual operational mechanics of a nuclear utility. Nuclear reactors provide baseload power, meaning they run 24 hours a day, 7 days a week, 365 days a year.
Right, they never stop.
Exactly. And they refuel in these 18 to 24-month cycles. But the actual nuclear fuel cycle, like taking raw uranium out of the ground, converting it to a gas, enriching it, and then fabricating it into fuel rods.
That takes a lot of time.
It takes about 2 years, the whole process. So a utility company does not care what the spot price is on a Tuesday in July of 2026 because their reactors are already fueled for the next 2 years.
Oh, I see.
They're looking at their reactor loads for 2029, 2030, and 2031.
So they're basically just buying an insurance policy.
They are buying certainty. That's exactly it. They're paying that $9 premium because their internal modeling is showing them that when this new fleet of global reactors actually comes online at the end of the decade, physical uranium is going to be incredibly scarce.
Wow.
Yeah. They are concluding that the pounds available at $86 today simply won't exist at any price when they actually need them to keep the lights on in 5 years. So the OTC spot market is pretty much irrelevant to the long-term thesis here. The really sophisticated buyers are expressing their true conviction in that $94 to $95 term market.
Okay, I follow the logic on the term premium, but how do we reconcile that underlying panic from the utilities with what the equities are doing?
Yeah, that's a big question.
Because you look at Cameco, ticker CCJ, which is, the 800-pound gorilla in this space. They make up about 43% of the entire sector's market cap.
Huge chunk of it.
Right. And they close Wednesday down 2.75% to 84.57. That's a drop of roughly 14% from recent highs. So if utilities are terrified of a supply squeeze, shouldn't the premier mining stock in the world be hitting all-time highs?
You would definitely think so, but the equity sell-off is being driven by a fundamentally different mechanism than the physical commodity. Well, the equities are bracing for a very specific near-term binary event, which we will get into when we look at the Friday earnings setup. But to your point about the physical market, you cannot look at a 14% dip in Cameco and assume the nuclear renaissance is stalling.
Right. Especially not when you look at the physical infrastructure the U.S. government just committed to building this week.
Exactly.
Let's pivot there, from paper pricing to physical policy, because this is where the divergence becomes undeniable. So on Wednesday, July 29th, the Department of Energy shortlisted 5 states for what they are calling Nuclear Lifecycle Innovation Campuses.
Yeah, this was huge news.
And the states are Utah, Tennessee, Oklahoma, Louisiana, and Idaho. And the scale of this is just staggering. We are talking up to $50 billion in potential capital investment per campus.
Per campus, yeah.
Which means nearly 25,000 jobs created per site. And they cover the full life cycle, right?
Yeah.
Enrichment, reprocessing of used fuel, waste disposition, advanced reactors, and specifically co-located data centers.
Yep, that's the key detail.
Utah even signed a formal memorandum of understanding for a site in remote Tooele County.
But I have to push back here for a second.
Go for it.
Because we hear about government, working groups and feasibility studies constantly.
Sure.
They usually generate this massive PDF and then just vanish into the bureaucratic ether. So why should anyone view this as actual tangible infrastructure rather than just political vaporware?
It's a fair skepticism. Totally fair. But the difference here is the geographic mandate.
Meaning what?
Meaning this isn't the government commissioning a study on the theoretical benefits of nuclear energy.
Yeah.
This is the government deciding the exact physical locations where the domestic supply chain will be rebuilt.
Oh, I see. They're putting pins on the map.
Exactly. We have to remember the geopolitical context here. The United States has spent decades being heavily reliant on foreign enrichment services. So this week, the administration essentially planted flags in 5 specific states and said, this is where we break that reliance. Okay, but building out a full domestic fuel cycle, enrichment, reprocessing, waste management, that requires an astronomical amount of capital. $50 billion per campus doesn't just materialize out of thin air.
Right, and that brings us to the most critical detail in that DOE announcement, the co-located data centers.
Yeah.
This is the structural genius of the policy design. Think about the tech sector right now. The major hyperscalers are in an absolute arms race for artificial intelligence and cloud computing dominance.
Which takes massive amounts of power.
An unfathomable amount of uninterrupted baseload electricity, yeah. Wind and solar cannot provide 24/7 uninterrupted power at that scale without massive, economically unviable battery backups.
Well, they need nuclear.
The tech sector desperately needs nuclear power, and they actually have the capital to fund it.
So the government is essentially playing matchmaker here.
Yes. They are pairing Silicon Valley's ravenous demand for clean baseload power with Washington's strategic national security need for a domestic nuclear fuel cycle. By co-locating data centers on these nuclear campuses, the government is creating a built-in commercial off-taker. The tech companies guarantee the power demand, which then justifies the massive infrastructure spend required to build the enrichment and reprocessing facility.
It creates a structural floor.
Exactly. A structural floor for domestic uranium demand that is completely insulated from whatever the spot price does on any given day.
And if the government is dropping that kind of capital in specific states, the local real estate and mineral rights suddenly become the most valuable chessboard in the country.
Oh, absolutely.
Which perfectly bridges us to the corporate maneuvering we saw right next door to Utah this week.
Yeah, this is a wild one.
So Uranium Royalty Corp., URC, completed this massive $1.9 billion enterprise value acquisition of a company called Sweetwater Royalties, and they officially listed on the NASDAQ as new URC. But here's the curveball that really threw me. Sweetwater is a Trona royalty business covering Wyoming, Utah, and Colorado. And Trona is sodium carbonate. It's an industrial mineral used in glass and lithium battery cathodes. And then Uranium Energy Corp., UEC, strategically disclosed they took a 7.7% stake in this new URC.
Yeah.
I have to admit, I was deeply confused by this at first. I mean, why is a pure-play uranium royalty company buying a massive royalty book for sodium carbonate? That feels like a software company suddenly buying a chain of grocery stores.
It totally does. It seems completely out of left field until you look at the mechanics of the royalty business model and, more importantly, the geographical map.
Okay, walk you through it.
First, let's look at the financials. So a royalty company provides upfront capital to miners in exchange for a percentage of top-line revenue over the life of the mine.
Right.
The biggest risk for a pure-play uranium royalty company is cyclicality. If the uranium spot price crashes, their cash flows dry up. So by adding a nearly $2 billion Trona royalty book to their portfolio, new URC just acquired massive uncorrelated cash flow.
Meaning their survival isn't entirely tethered to the roller coaster of the nuclear fuel cycle.
Exactly. Trona demand is driven by industrial processes, glass manufacturing, and increasingly the lithium extraction process for electric vehicle batteries. It operates on a completely different macroeconomic cycle than uranium.
That makes sense.
But the real masterstroke, the reason USC took that 7.7% stake, is the geography. Sweetwater County in Wyoming contains the world's largest known Trona deposit.
Right.
By making this acquisition, new URC essentially established Wyoming as a dual critical minerals hub.
And Wyoming shares a border with Utah.
Yep.
Where the DOE just announced that potential $50 billion nuclear campus.
You're seeing the chessboard now. UEC understands the geology, the permitting process, and the politics of that specific Wyoming-Utah basin better than almost anyone in the sector.
So they didn't buy into new URC because they suddenly want to make glass?
No, not at all. They took that stake because they are positioning themselves at the geographic epicenter of where the U.S. government is directing the future of both critical minerals and nuclear energy. They recognize that the land right next to the new superhighway just went on sale.
Okay, so a massive royalty acquisition de-risks the balance sheet, and a government memorandum sets up the future demand.
Right.
But those are just paper agreements, For this thesis to actually hold water, for domestic supply chain to exist, you need raw physical uranium coming out of the ground on American soil.
You need dirt moving.
Exactly. And that transition from paper to physical production actually happened this week in Texas.
Yes, it did.
UEC's Burke Hollow In Situ Recovery, or ISR, mine commenced production. It is now the world's newest operating ISR uranium mine. They have a 2,500 gallons per minute capacity ion exchange plant up and running, which feeds directly into their Hobson Central Processing Plant.
Which is licensed to crank out up to 4 million pounds a year.
Right. So break down how ISR actually works mechanically, because I think a lot of people assume mining is just moving dirt.
Yeah, they picture massive open pits in Africa or deep underground shafts in Canada, which take, a decade to permit and billions of dollars to build. But in situ recovery is entirely different. With ISR, you aren't moving earth at all.
How does that work?
You basically drill a series of injection wells and recovery wells into the ore body underground. Then you pump a specialized solution. Often it's really just groundwater mixed with oxygen and a little baking soda down into the deposit.
Okay.
The solution dissolves the uranium right where it sits in the rock. You then pump that uranium-rich water back to the surface, run it through an ion exchange plant to strip the uranium out and recirculate the water.
That sounds way more efficient.
It is exponentially cheaper, much faster to bring online, and has a fraction of the environmental footprint of conventional mining.
And UEC controls the Hobson Central Processing Plant, which is the bottleneck for all that regional ISR production.
Yeah.
And they also managed to do this with zero debt and $794 million in liquid assets on their balance sheet. Why is that zero debt metric so crucial mechanically?
Because debt carries covenants. If a mining company takes on massive debt to build a mine, the bank usually requires them to sign offtake agreements at lower prices just to guarantee the debt payments.
So they're locked in.
Right. Or, if the spot price dips, they are forced to sell their physical uranium into a weak market just to keep the lights on. But because UEC has zero debt and massive liquidity, they operate from a position of absolute leverage.
So they aren't forced to sell a single pound into an $86 spot market.
Not a single pound. They can stockpile their production, or they can wait for utilities to meet them at that $95 term price.
So if you contextualize this with a pending Section 232 government review, which, for those tracking, is evaluating whether to force U.S. utilities to buy domestic uranium for national security reasons, UEC is essentially front-running the policy. If Section 232 acts like a Buy American mandate for nuclear fuel, UEC didn't just buy a billboard advertising their future plans, they just stocked the shelves of the only brand new store in town, and they don't owe the bank a dime.
That is exactly the operational weight Washington needs, because a domestic sourcing mandate is useless if there is no domestic source. UEC turning the valves on at Burke Hollow provides the physical proof of concept for the policy the administration is trying to write.
Which brings us to the ultimate showdown of the week.
Here we go.
If the physical reality in Texas is robust, and the policy reality in Utah is locking in billions of dollars of future demand, and the term market is screaming that a supply deficit is coming, why are institutional investors dumping the biggest stock in the sector?
Yeah, this is the element in the room.
Because the street consensus for Cameco's Q2 earnings report on Friday is projecting a 49% year-over-year earnings per share decline, down to 26 cents a share. If I see a 49% drop for the industry bellwether, I immediately think the company is in fundamental trouble. Are we absolutely sure this isn't an actual crack in the broader uranium thesis?
It's a completely rational reaction for an everyday investor to see a 49% drop in earnings and hit the sell button. I mean, it looks terrible, but this is where you have to look at the plumbing of uranium contracts, specifically something called mix effects.
Unpack mix effects for us, because that sounds like accounting jargon used to hide bad news.
I know it does, but it's actually just the reality of long-term contracting. See, Cameco does not sell the majority of its uranium at whatever the spot price happens to be on a Tuesday.
Okay.
They have a massive, layered portfolio of long-term contracts signed over the last decade. Some of those contracts are indexed to current spot prices, but many of them are fixed-price contracts that were signed years ago.
When uranium was much cheaper.
Exactly, when it was trading at $30 or $40 a pound. So depending on the specific delivery schedule of a given quarter, the mix of those legacy contracts hitting the books can severely drag down the average realized price.
So they are legally obligated to deliver uranium at 2019 prices, even though the spot price today is $86.
Precisely. And when you compound that contract mix with the severe operational issues they faced in Q2 specifically, they had massive flooding at their McArthur River and Key Lake operations in Canada.
Oh, right, which forced them to fly personnel and equipment instead of using roads, right?
Yeah, which is incredibly expensive. So you get a severe margin squeeze. The cost of production spiked due to logistics, and the legacy contracts dragged down the revenue. That results in an incredibly ugly headline EPS number.
So the pre-earnings sell-off isn't a rejection of the nuclear renaissance at all.
No.
It's just institutional funds clearing out of the stock because they know the algorithmic trading bot's going to punish that headline EPS miss.
It is purely institutional repositioning ahead of a tricky quarter on paper. But the headline, EPS, is not the metric that actually matters to the structural thesis.
What should we be looking for on Friday, then?
What matters on Friday is the realized price per pound on their new contract activity and their forward contracting book. They're required to deliver 28 million pounds a year through 2031.
Because that tells us if the commercial machine is actually working at today's prices.
Yes. If Cameco shows they are successfully executing new contracts at prices that validate that $94 to $95 term market, it cuts right through the headline noise.
Right.
And furthermore, you have to look at the supply side constraints we are tracking elsewhere. Like NextGen's massive Rook-I project in Canada is currently in week 8 of its summer construction window, and they still haven't announced a groundbreaking.
Which means delays.
Every week that project is delayed means millions of pounds of uranium will not hit the market in the late 2020s. The supply side is getting tighter, not looser. So if Cameco beats on their realized price, validating the term market, it will likely spark a massive sector recovery regardless of those legacy mix effects.
So let's zoom out and connect all these dots.
Right.
We started this deep dive looking at a market that seemed broken, a frozen spot price, and an impending 49% earnings drop for the sector leader.
Yeah, a lot of red flags on the surface.
But by looking past the surface-level stock tickers, we found a $50 billion government blueprint mapping out the physical geography of the American nuclear supply chain. We saw strategic acquisitions establishing dual critical mineral hubs right next door to those planned campuses. We saw a completely debt-free company physically producing in-situ uranium in Texas, effectively front-running government policy.
Right.
And we learned that the looming earnings disaster is actually just the delayed accounting reality of contracts signed years ago.
It proves that you cannot manage a portfolio in the sector by just reading the daily temperature of the equities. You really have to understand the mechanics of the physical commodity and the policy driving it.
If you are trying to spot structural, generational infrastructure being built before the broader retail market catches on, this week in July is the blueprint. I mean, the pieces are physically moving on the board, establishing a supply chain that will operate for decades, while the stock ticker is obsessing over a 3-month accounting mix effect.
And if we look closely at how those pieces are moving, it raises a really profound question for the next decade of energy markets.
What's that?
Well, the DOE specifically engineered these nuclear campuses to include co-located data centers.
Right, for the tech companies.
Yeah. So if hyperscalers are demanding dedicated, uninterrupted, carbon-free baseload power to win the global artificial intelligence race, and the U.S. government is actively mandating the creation of a domestic fuel cycle to feed them, what happens to the supply and demand equilibrium of the global uranium market when the most heavily capitalized technology companies in human history effectively become nuclear utilities themselves?
That is a staggering thought.
Yeah.
You're talking about injecting the balance sheets of Silicon Valley into a physical commodity market that is already panicking about scarcity.
It would completely rewrite the rules of the market.
It all loops back to the very beginning. The financial thermometer is shattered. You can't just read the temperature anymore. You have to understand the plumbing. And this week, the plumbing is telling one hell of a story. Keep your eyes on the physical reality, and we'll catch you on the next deep dive.